Well, good morning, everyone. Welcome to the sixth installment of the JCCS Live Q&A webinar. I've got 9 o'clock straight up, so we're going to get started with some housekeeping items. I see we've got people still logging in to the webinar, so give them time to do that, and we'll just do a couple of housekeeping items. So just a comment here, we are recording this webinar similar to prior sessions, and the recording will be available on our website sometime Monday, probably late in the day or at the latest Tuesday sometime. So for those of you who need that web address, we've got that listed on the slides here. So feel free to jot that down. I know we get a lot of questions about the location of that recording after each session, so got that there. So our plan today is really to take a significant part of the webinar time for viewer questions. So feel free, if you're logged on, to start loading those Q&A, those questions into the Q&A section as soon as you want, and we'll take those as we can. And then also remember, participants, you can vote those questions up so we get the most popular questions up to the top and get those covered in the time allotted. Also, just a reminder to steer all of your questions related to content into that Q&A section rather than the chat window. It kind of makes monitoring two areas a little bit easier. So if you got technical issues, you can throw those into the chat, but Q&A for the content, be sure to put that into that other section. So as far as the agenda for today, we're gonna spend a little time covering the PPP Flexibility Act that was passed last week, signed into law. We were really hoping to have a little bit more guidance issued by now. We do have a little bit of guidance that's meaningful for everyone on the webinar today. So we'll cover that and then answer as many questions as you have available, of course. And then we'll also be covering the original application guidance, because there are some of you on the call today that are going to look to use that original 8-week period. So we just want to reaffirm what that guidance is. Aaron's going to spend a little time on that. So for those of you who are looking to apply, you'll have that available to you. Lastly, I'm going to cover the EIDL a little bit. I know it wasn't in the description of what we're going to cover today, but we've gotten a lot of questions on EIDL as we've seen more of our clients being offered EIDL loans. So we want to talk a little bit about what that means. So we'll spend a few minutes on that as well. So without any further delay, I'm going to hand it off to our panelist, Jake Carter.
Awesome. Thank you, Tony. Well, good morning, everyone. As Tony mentioned, a couple of the items that we're going to talk about today is obviously kind of the latest and greatest that has come out in some guidance. And that is the Flexibility Act of 2020, the PPP Flexibility Act. And I think a lot of us have read a lot of things. I think the number one, the biggest, most important change was the extension of the time that you can use the funds. It was originally an 8-week period, pretty condensed. They thought that we could kind of turn things around a little quicker. And that didn't quite happen in every industry. And so there was a big push to get that extended. So that's now a 24-week period to use those funds. A couple just notes on that. It cannot be beyond 12/31/2020. So roughly in July, we're going to get to a point where people can still apply for a loan if they haven't already, the PPP loan. Well, actually, they can't. It's going to... Sorry, I backtracked there. They have until June 30. We'll talk about that to apply for a loan. So really 12/31. Not sure why now that I think through that date calculation, it's kind of odd. But in essence, the period can't go beyond 12/31. And you can actually keep the 8-week spending period. We'll talk about that a little later. But in general, everyone got extended to that 24-week period. Another big change from this act was that it was originally a 75-25 rule. You had to spend 75% of your loan on payroll costs, and now that was reduced to 60%. And so then obviously the other 40% are those non-payroll costs we discussed in previous webinars. Look back to those to get true definitions on what those are. But it's now, we got to be thinking a 60-40 rule. Upon first issuance of this act, it was kind of interpreted that this was a cliff, meaning if you were at 59% payroll costs, nothing would be forgiven. Under the prior rules, we were on the understanding that you could have partial forgiveness, and so the 75% rule was just a function of the total amount to be forgiven. So they kind of later backtracked and said, no, it's not a cliff. It really is a 60-40 rule. But if you only spend a certain portion of if you only spend 55%, then your loan forgiveness amount just has to get reduced to make sure you get to that 60-40 ratio. Some more takeaways. This one, the first one, there's a couple safe harbors issued. They have to relate to FTEs, the FTE calculation, the full-time equivalent reduction calculation. So there's two safe harbors really that have to do with that. One is if you're unable to find qualified workers, we're going to probably need to get more guidance here, but this is their verbiage. They're essentially saying if you're struggling to find somebody to fill the role for whatever reason you had to lay people off before, they understand that maybe shouldn't affect your FTE reduction. So they're looking at those pre-COVID. They're using February 15th as a guideline. What was your FTE then? We'll give you a safe harbor if you can't restore to that level and they're using the date December 31st. So with these new safe harbors, your dates are February 15 and December 31 of 2020. And so so one of the safe harbors is inability to find a qualified worker to replace that person. And then two, if you're unable to restore your operations because of COVID. So again, pretty broad. We're going to hopefully see if they give us maybe an example or two of what that means. But in general, what they're trying to do is really just kind of relax the pain of this FTE reduction issue, and these are what they gave us. So look, this is one of those odd areas that we're going to see probably more guidance on. Another provision here of this new act is that there was an extension of the loan repayment period. So remember, this is a loan. Obviously, we're looking for a 100% forgiveness, but if you can't achieve that, then it turns into a loan for that portion that's not forgiven. And so prior to June 5, they're using that date, June 5, it was a 2-year loan. And now in this new act, they're saying all loans after June 5. So if you haven't gotten a loan yet, or just recently achieved one, you have now a different payback period for your loan. And it's still at 1% interest rate. We did get some guidance just the other day, earlier this week, that it sounds as if, though, it looks like if you, the borrower, and your bank come to terms, you could, even though you have a loan that was issued pre-June 5, sounds like if you're able or need to, you could possibly turn that into a 5-year loan. So contrary to what I'm telling you here, as it's written, it's still a 2-year loan if you have it before June 5, but it sounds like if you work with your bank, it's possible that you can agree to that 5-year term. And then a couple of the final two or three takeaways here. One is the extension of payment deferment period. So again, if you do need to have a loan, if this does turn into a loan and you don't have that 100% forgiveness, yes, there's that 2 or 5 year term, but then when do you have to start paying it back is the real question. And so what they did was they clarified that that period begins when the SBA remits their loan forgiveness to the bank. So you're going to submit your loan application to the bank reviews it, works with you to make sure that you're in good shape. They submit it to the SBA, and then the SBA turns around and tells the bank, we agree, disagree, or you come to terms what the actual answer is. That moment, that's when your loan then becomes, it's time to start paying on that loan. And so if the borrower does not go through that process of loan forgiveness, so they just say, we're just going to, we owe it all back. Because there is no, SBA is going to send something back to the bank, we have to come up with a number, so they use 10 months as that number after the covered period. Important to note, So if you're thinking about applying for loan forgiveness, we'll talk about this probably in a little bit. So when you submit your loan application, you have 10 months to submit that forgiveness application from the end of your PPP period. That's kind of how we're interpreting right now. Aaron will talk about that. And then confirmation of the loan application deadline. Kind of touched on this earlier. So it does remain at June 30. So that's coming up. If you have not gotten or secured a PPP loan, maybe thinking about it, wasn't sure if it was for you, maybe it wasn't looking favorable at the time. I know I've got a couple people I'm talking with right now that are still on the fence of applying for one because it's either looking like it couldn't work. Maybe this 24-week extension will help now. Just know June 30 is the deadline to apply for a PPP.
Hey, Jake.
Yes.
Got one question here. Can a business apply for a second PPP loan?
No. You're only good for one loan. Only good for one. That's a good question. Yeah, because I think the buzz right now is that there's all this money still sitting out there, right? And so, can we keep using it? In theory, that sounds great, but intentionally, we're trying to get it to all businesses. There's a lot of businesses that either could not only use the money, but haven't applied for certain reasons. One, compliance. Two, wasn't sure if it would work for them. They were worried about this 8-week period, and knowing that they had to spend it within those 8 weeks. And so I think we'll see those funds start getting tapped into now that we're seeing a little bit more. The guidelines are getting a little more loose on how we can use how long we have to use them. So unfortunately, no, can't do a second loan.
Great.
And then the final point that I'll talk about is just simply deferral of the employer portion of Social Security taxes is now available to businesses that receive the loan. If you recall in some of our prior webinars, we were discussing other options. There's the payroll tax credit. And then there's also, and there's the EIDL. All these options were made available for businesses. And one of those was that to kind of help with cash flow, they said, you know what, you can wait to pay some of your payroll taxes. But they said, however, you can't do that if you had a PPP. And so they're listening to people, and it sounds like that people could not only use the PPP but also the cash flow help, and so they've loosened their reins on this provision as well. Okay, that's it for the Flexibility Act. I'll give it to Aaron to kind of recap a couple other items.
Hey, Jake, I think we actually want to take some of the questions because a lot of them are related to the 24-week.
Okay.
The one that's been voted up the most is, do we need to track expenses for 24 weeks or just until we've depleted the funds 10 to 12 weeks approximately or further?
Yeah, that's a great question. I would say, what would I say? The answer, I would say, is you need to keep track. I would keep track. If you're going down this road of monitoring what you're spending on payroll and you're monitoring what you are spending on rent, I would continue keeping track the entire time. However, because what's really coming to my mind is that when we were looking at this 8-week period, so pre this as an extension, we were really kind of struggling or really looking to try to find every potential cost we could to jam in to this 8-week period. And so this extension not only maybe frees us up from having to get maybe overly aggressive or trying to figure out who we can pay, it now loosens that to that 24-week period. So yeah, I think a lot of people are going to go through these funds far quicker than 24 weeks. I would be under the impression that we should continue to track the entire time. I don't think that's a requirement. The loan application is going to probably be specific. We have yet to see this new application, but it's probably just going to say list your costs during this period. I guess if you understated that cost, I don't think that would be a detriment. But it's, the question's going to be, how much did you pay in payroll costs during your covered period? And I would think you're going to want to tell them exactly how much that was. And if it's far over your number, well, you're just ensuring yourself a greater chance to get it fully forgiven. So, what is your? That's a great question. I'm assuming, and we'll talk about it. I think you've always been able to apply kind of whenever you're ready. And I'm taking the position, we've talked about it as a group. I'll share it with everybody that's watching this. I'm under the impression we need to kind of slow the roll a little bit and let things develop. It's incredible. I really think we're going to get more safe harbors. I think they're going to continue to come. And as they do, it's that much less work you have to do on your loan application. Fingers crossed, obviously, but I find it hard to believe they're going to tighten down on rules. So,
yeah, a couple things.
Yeah, what do you think, Tony?
Couple things that I've heard, not necessarily on the tracking expenses, because I think, you're going to track expenses to the maximum of your PPP loan. That's for sure. But we've got this 12/31 FTE calculation date. So you're certainly going to have to do some additional FTE calculations. I've also heard a lot of, so I spoke with several larger banks this week just to kind of get a feel for their application process. And there's an overwhelming feeling that the documentation burden is going to be eliminated for small loans. So again, to your point, Jake, of kind of slow your roll if you're going to go under the 24-month period and you're allowed to apply as soon as you spend your funds, you still may want to wait a little bit and let all the guidance settle. So.
Yep, I echo that for sure. Any other questions, Aaron, that I wasn't monitoring the Q&A, I'm sorry. So any others that you see that are applicable to this topic?
We have some kind of just comparing the 8 weeks to the 24 weeks, which I'll kind of get into at the end of my section. So maybe we'll answer those then. Great. I think I'm not seeing any other specific. Are you, Tony?
Maybe I'll just take the form.
Yeah.
Do you have to wait for the new form to be issued? So then if you're using the original 8 weeks, I believe you apply on that original form. They may come out with a hybrid form, but all the articles, all the guidance that I've read this week indicate that if you're going to apply, you can work with your bank to see if they'll accept that original application. So there's no hard and fast yes or no on that. There are some banks that are simply not ready to receive your applications yet. So depending on who you're borrowing from, that's going to be the answer, whether you can apply on that original application or not.
Yep, that's what I've read as well, Tony. It sounds like there's a new form that's going to come.
Yep. So let's hop into the application process. If you decide that you do want to do the 8 weeks, your 8-week covered period, if you want to file for forgiveness early, you definitely can. Sounds like financial institutions are going to be accepting the original application that was published out. I haven't heard anything different. I don't think Tony or Jake has. Correct me if I'm wrong. The original due date for that application was October 31st. We don't have a confirmed due date for the new application because that 24-week period will end 12/31 of 2020, or the 24-week covered period ends 12/31/2020. I would expect the due date to be sometime in maybe late Q1 2021 or early Q2 2021. So we'll see, hopefully get more information on that. If you are prepared to apply, it sounds like most financial institutions are going to be ready to accept those 8-week covered period applications. To go over the items that you'll need, you will need a kind of a general list of different calculations and different bits of information from prior year, from the current year, your covered period. So we've made a little list here of what you will need to have. For your FTE calculations, you'll need to do quite a few of them. You'll want to look at your 2 look-back periods to see which one is more favorable. You'll want to check your FTE average as of 12/15, your FTE average, between 215 and 426, your FTE at 630. And then if you do go the 24 week, you'll want to do the 1231, but talking strictly about the 8-week covered period, you want to know it as of 630. And then you need to know your FTE average throughout your 8-week covered period. So a lot of FTE calculations there. There are some, they did make a kind of simplified method where anyone working less than 40 hours is just considered a 0.5. Anyone working 40 hours is just a even 1 FTE. So you can use the simplified method, or you can go by a divisor of 40 hours a week. You'll want to look at your FTE comparison to determine if your decrease in FTE is present and if you have an applicable safe harbor for that FTE. So that's part of the reason why we have so many different FTE calculations. It sounds like a lot of work. It's not too bad, I guess. It depends on how many employees or how much information you're gathering, I suppose. The other testing information that you will need is the salary and wage rate information for Q1 as of 2/15 during the period of 2/15 to 4/26 during the 8-week covered period, and as of 6/30/2020. And this is very similar to the FTE safe harbor calculation where you're comparing the different wages. In this case, it is a wage rate. Initially, in the CARES Act, when we were talking about this, we all thought it was going to be a gross wage comparison. If the gross wages compared to Q1 wages were decreased or increased, how would that look? But with this application, they have stated that it's the rate that you pay individuals. So we've had some questions about unit pay or piecework, commissions pay. So we're interpreting it as long as your rate that you're paying, so if you normally pay a 15% commission rate and you've retained that 15% commission rate, that is no decrease in their wage rate. So you don't have to worry about a reduction in forgiveness. Same thing for hourly rates. If you didn't have change someone from $12 an hour to $10 an hour, if you didn't do that, then you wouldn't have a reduction in forgiveness. Now, if you did, you do have some time to make that up, but it's all around the rate that you pay as opposed to a gross wage. Tony, did you have any additional thoughts on that? I know we kind of talked back and forth when I was doing that tool.
Yeah, I think that's probably the biggest aha in this whole calculation is, we used to reemphasize that we interpreted this as to be dollars paid to employees, but it's not unless they're on salary.
Right.
So salary, if you reduce their salary over the time period, then you've got a wage reduction. But if you didn't reduce their hourly rate, you've got no issues on wage reduction in your PPP calculation. And I think that's a big takeaway.
Yeah. And it took away a bit of that almost double penalty where you were penalized for having a reduction in hours because your FTE count was decreased, and then you were also getting a reduction because you weren't paying as much. So now they took away the penalty for not paying as much by saying, hey, if you kept them at the same rate, maybe you just had to reduce hours, you're okay. You only have the reduction based on the FTE reduction. So it's actually very nice. I know we talked about that in our last webinar, but I think as we've been digesting the application and reading more, really digging into it and getting more guidance, that's become the real, like Tony said, the aha, like, okay, this is a good thing that we're seeing come out. If you do have a reduction in rate of pay or wage rate, then you will also need to know your average hours worked per week in Q1 as compared to the covered period, so you can calculate out the wage rate, the reduction, because they won't qualify for the safe harbor there. Additional information to have at hand is the compensation numbers from 2019 for any of your owner employees, self-employed individuals, any partners that are receive guaranteed payments, anything like that. You're still capped at that 2019 number. We will talk about the 8-week versus 24-week cap in a couple slides. So we'll get there. I know that's a pretty common question we're getting. You'll also need some annualized compensation numbers to determine if any employees were over the 100,000 compensation threshold, just to see if they were over that, whether you can exclude them from the reduction in wages forgiveness reduction, or if you have a cap that you need to put on that individual. You'll need all your non-cash compensation, which is your insurance, retirement benefits, your state and local tax assessed on wages. You'll need your backup of all of that, your other covered cost amounts, so rent, utilities, all of that, and the supporting documentation for all your calculations and amounts. Now, we don't know exactly what the banks are going to be asking for. Do they want just a printout of everything? Do they want it electronically? I don't think we know exactly what to expect, and I think Tony can talk to that a little bit as well.
Sure. So if you want me to do that now, I can.
I think I have it coming up in just a minute.
Okay.
So we'll talk about that in a minute. I don't think I had anything on that last slide. Nope. So for our FAQs, our frequently asked questions, many of which we don't have answers for yet. The biggest one, of course, is that the 8-week limitation on owner, employee, self-employed individuals, partners. What about health insurance and retirement benefits? Are those amounts capped at the 2019 amounts, or is it included in the total cap on those owner employees? There's not a lot of guidance there. It just says 8 out of 52. I think we've seen a lot of disagreeing information. Some people are saying the health insurance and retirement are above the cash compensation. Some are saying, no, it's capped at this amount. So we still don't have a firm answer on that, unfortunately. And going forward for the 24-week covered period, the follow-up question for that is the cap on cash compensation for everyone still at the $15,384, or are we able to extrapolate out what the 24-week cap would be? No guidance on that yet, so we're still waiting. FTE calculation was, do FTE levels need to be sustained through the 24 weeks if you do choose the 24-week period? We don't know exactly what that means. We know we have to be back up at 12/31, but what happens in the interim there is kind of, I think, still a bit of an unknown. We also need to know what constitutes allowable retirement expenses. There's been a lot of going back and forth on what qualifies, so we still need guidance on that. And the final question that I think we have the answer for is, should businesses file for forgiveness immediately if they're ready, or is waiting better? And as Jake said earlier, waiting may be best just because it may reduce the amount of work that you have to do to support all of the information. It may be, I mean, we've heard people saying they're just going to do a blanket forgiveness on all the small loans, so you don't have to go into putting into all the time and effort in calculating all these amounts. If we wait a little bit to see what other guidance comes out. We do have a due date on the 8-week original application for 10/31, so we've got a while. And I think in most cases, waiting is going to be the best option there. There's nothing hurts waiting. And then also back to what Jake said, what does the 24-week extension mean in reality for us? And I think for us, it tells us that we don't need to be as aggressive and as pushing to get all of those covered costs done in those 8 weeks. It gives us a little bit of breathing room there, where we can really make sure we're choosing the right expenses, paying them correctly, and everything. So this is where we're going to go to Tony on if you do choose to do the 8-week application, or if you choose to do 24, all of that good stuff, what to expect.
Yeah, so like I said, I spent a little time this week. I reached out to several of the larger banks in the Montana market. And what I wanted to do is get a feel for what does the application for forgiveness look like from their perspective. So we could convey that to our clients and allow them to be prepared for whatever's coming. And what I found is that every single bank is completely different in their approach. So if you're concerned or you're going to be applying soon, you need to reach out to your bank and see what their protocol is going to be. So, but here's the range. So you've got very sophisticated. We've got some banks that are using a third-party outsource, and it's going to be an electronic portal. So you as the borrower will be required to basically fill the boxes, online application through their portal. You'll upload all your support electronically. It will submit through that third party and be evaluated and approved there and then routed to the SBA electronically. On the other end of the scale, we've still got some banks that are doing completely in-house. So their process is going to be, hard copies. You can probably still email it to them. But if you bring them a stack of paper, that's really what they're prepared to do, is evaluate your documentation based on printed documentation. So really you've got the gamut, and the message is to talk to your bank so you can be prepared and have that information in the format that they're going to ask for. And some are using kind of in that middle hybrid, like using a DocuSign fillable application, but yet you've still got to upload and email all your support. So really you've got everything in between there.
Great. Do we want to answer some of the questions, get them out of the way before we head on to your section, Tony?
Yeah, let's take that. Can you choose the 8-week or 24-week period? I don't know, Jake, do you want to comment on that? I think we kind of covered that a little.
Yeah, the answer is yes, you can. They're obviously, with this new act, they've extended it to 24 weeks, but they have stated that you can elect to use the 8-week period. So the answer is you can choose. And why would one be better than the other? I don't know how the 24-week could hurt you, other than you're not getting closure as fast. So it'd be more of a mentality thing, I think, at that point, or assuredness of cash flow or something. So I would think that there's really no downfall to waiting for that 24-week period, other than we just don't know what the loan looks like.
Yeah, I think the one thing that sticks out to me, Jake, is the need. So if your business model is changed because of COVID,
Mm-hmm.
and now you've got this 24-week requirement to maintain your FTE count. So, I mean, that's where I think you might lean more towards, even if I don't have full forgiveness, it may be beneficial for me to apply under the 8, so I don't have to maintain my full FTE count if my business model has changed.
Mm-hmm.
So something that I guess I would have to research would be, if I go with the 8-week period, is the 6/30 FTE date still in play?
It is, I believe
Okay.
so.
Okay. Because I thought they struck that date in the Forgiveness Act, but that'd be, or the just this latest act. So that'd be the only thing I'd have to research. Because you're right, Tony. Yes. If for some reason you thought that maybe it was going to get worse by December 31, then you're going to run into that issue, as opposed to maybe today, coming up June 30, you're kind of on the fence. Yeah, that's a great point. Good point.
I would say when you are choosing that, maybe you choose the 8-week, and that because that fits your business model or your FTE count best, but that we're still waiting a little bit longer to actually do that application. Like I said, the original due date was 10/31. We've got time to hold off and see if there's more guidance. So even if the 8-week looks more attractive as better for calculating FTEs and all of that, you may still want to hold off just a little bit longer as Jake said, slow your roll a little bit, just to see what additional guidance comes in, because it may end up saving us and everyone a lot of time. There is a question about what dollar is a small loan. I've seen amounts thrown around of 100 to 150,000. Anything below that? Have you guys seen anything else?
Same. Yep. That de minimis is kind of in that 100,000 range is what the banks feel. So
Perfect.
Yep. I think the average loan they said in the nation was it 150?
Montana's 109. So I did the math on that this week. So 109 is the average in Montana. So we're looking at probably 85% of loans are going to be under that $100,000 level. So.
Right. Yeah. Yep.
Jake, I know you did, I think it was one of you did the taxable income breakdown and how the PPP forgiveness is going to affect taxable income back maybe 2 webinars ago. I haven't heard any changes on that. Could one of you, whoever did that part, can you talk to that?
I'm going to defer to our resident tax expert, Jake Carter.
And I was going to defer to Tony. There has been no change. It is our understanding that it is still effectively it's taxable, because the way it reads is that any dollars that you spend with your PPP loan and get forgiven will not be allowable deductions on your tax return. So if you walk that through and you spend all of your $150,000 of PPP funds and get it fully forgiven, if you think about your ending financials, you have these $150,000 of write-offs. Got to clear those off. That's our understanding right now. Mm-hmm. I hope we get a little bit more guidance on that. I've been talking to other CPAs about how they are expecting to address that issue. And I'm actually getting kind of a couple of differences of opinions. In theory, there's going to be a reduction in expenses, which will effectively create taxable income, which will effectively increase your tax bill. But at the end of the day, your net effect from this is going to be positive. Your cash flows are way up. It's not quite as amazing as they made it originally sound under the original CARES Act. Things changed, believe it or not. I can't believe it. Back to you, Tony.
All right. So I know we got some more questions in the Q&A. I'm just going to fly through some of this EIDL and other items, because I think it'll answer some of the questions in the Q&A area. So a lot of emails and phone calls in the last couple of weeks. The EIDL issue has resurfaced because we've got clients receiving offers. And then they're in turn reaching out to us and saying, should I accept the offer? So here are just some things that, top things that I advise clients, they need to understand what you can and cannot use the proceeds for. And I've got a slide next that kind of goes through that a little bit, so I'll defer on that. You need to understand that you may be required to issue a personal guarantee if your loan is large enough. Original EIDL loan program requires a personal guarantee at the level of $25,000 and up. However, this program under the CARES Act defers that. So if your EIDL loan is below $200,000, there'll be no personal guarantee. So you kind of need to understand that. Generally, that EIDL loan is set at 2 months of working capital. So that's, if you're kind of wondering, well, why did they offer me $60,000? Well, based on the summary financial information, they've calculated what 2 months working capital is going to be, and that's why they've offered you what they've offered you. So, but you got to understand that personal guarantee issue. Again, it's a loan. It's not a forgivable loan, so you have to have some expectation and plan for repayment in the future. Those EIDL loans can be up to 30-year repayments. So potentially very small payment, but there is a repayment expectation. and then you'll have to understand whether it affects your personal credit. So when they're applying, the SBA is using credit score as the main means for determining whether they're going to offer the loan or not. So that means likely the owner is asked to provide their social security number. They're doing a personal credit check, shows up on their credit score as a hard inquiry. So you need to know that there's going to be some expectation there. Will this be listed on your credit as an outstanding account? Shouldn't, because it's going to be in the business name, but they are going to do a personal credit check. So you'll have this hard inquiry on your credit. So then what can I use the EIDL proceeds for? So it's not as clearly defined as the PPP loan, but in general, it's a working capital loan. So this is to cover your regular operating expenses and loan payments, principal and interest, that cannot be otherwise covered by other capital sources or your ongoing operations. Okay, so that in a nutshell, that's what it's for. So in general, payroll costs, regular mortgage payments, you've got increases in your supply chain costs, and then any other expenses that you cannot otherwise pay. So if you're flush, you're fully operating, maybe this isn't for you because you don't have any other expenses that cannot be otherwise paid. You can always pay the payroll costs, but you may not meet that hurdle of other expenses that cannot otherwise be paid. So next slide, I kind of listed out what you cannot use the proceeds for. Okay, they're very strict on this. So you can't use it for bonuses or dividends. You can't disperse it to owners. You can't expand. You can't buy capital additions. You can't relocate your business. So the list there, I won't go through them all. But anyways, there's some very specific items, and I've had these questions from clients. Boy, this would really be nice for X. Well, unfortunately, that's what you can't use it for. So if you're undergoing some of these activities, maybe the EIDL is not for you and you should turn it down. So do we have any other, so I see we have a question on the EIDL there as well. I'll take that before I move on to some other potpourri items. So is the EIDL advance, the grant advance, automatically forgiven up to $10,000, or is there a forgiveness form? So yes, it is automatically forgiven if you are turned down for an EIDL loan or you refuse the loan. Okay, so you're done at that point in time. If you accept the EIDL loan, there is then going to be a forgiveness process. You have to actually ask for forgiveness on the advance. So it's one of two. If you take the loan, there's a forgiveness process. If you're turned down for the loan or refuse the loan, you're done, it's forgiven. So it's not required to be repaid. There's no additional steps.
Tony, as a follow-up on that question, if you were turned down or didn't get the EIDL loan, but you did get the grant, how does it then affect your PPP forgiveness application?
Yeah, so if you received an advance on the EIDL, regardless of whether you're taking the loan or turned down for the loan, if you received an advance, you need to have an expectation that you're going to have a PPP loan balance equal to your EIDL advance. The EIDL advance is forgiven. However, they've backdated all of those advances to, I believe, January or February of this year. So they existed prior to any PPP advance. So they're saying that anything that they reimburse the bank for, they're going to reduce the amount that they pay them by the EIDL advance, and thus you will have a loan for that amount.
So effectively making that EIDL advance not forgivable, right?
Correct. Yeah, which is completely contrary to kind of that original language. They said if you just didn't use them for the same thing, they could coexist.
Yeah.
And now they're saying, yeah, you can still have them both, but we're going to reduce your PPP forgiveness by the amount of the EIDL advance. And this is my opinion. I believe they did that so they did not have to worry about substantiation of the EIDL advance. So.
Sure.
Are you ready for the next page?
I'm ready.
Go for it.
So I think we actually already covered this a little bit, but what do they mean by retirement plan contributions? I'll kind of just touch on this a little bit. I know we even have disagreement within our organization on what this means. So the application is very general, saying insert your retirement plan contributions here. It doesn't say for 2020. It doesn't say for the covered period. It just says retirement plan contributions. So a lot of people interpret that to say, well, I'm about to fund my 2019 contribution. I'm going to include it. We don't believe that's what it means. I believe that it means for the retirement costs related to the payroll in your covered period. However, with this extension, we no longer need to be aggressive, and I think that's the message that I really want to convey. So now I don't think we have to press and say, okay, well, I'm going to put my 2019 contribution in there, or I'm going to pre-fund my entire contribution for 2020, those kind of things. We just don't need to as businesses anymore with this extension. So. Next, I just want to touch on voluntary terminations and terminations for cause. Just to be clear on that, so if you've got an employee who left you voluntarily to take another job, or maybe they chose to stay on unemployment or whatever that might be, or you've got a termination for cause during your covered period. The fear was that, okay, now my FTEs are going to be down and I'm going to be penalized for that. They came out with guidance and clearly said that if you've got either one of those situations, you can take those employees out of your FTE calculations so you're not penalized for any reductions that are either voluntary based on the employee's choice or you've got a termination for cause. So clarification there and very good guidance. Lastly, employee owner making $100,000 annually. Do you also get to include your health insurance and retirement contributions, or am I capped at $15,384 of total payroll costs? I've read probably a ton of articles on one side and a ton on the other. A lot of experts say that you can include health insurance and retirement contributions to get you to the $15,384, but you cannot go above the $15,384. I don't read it. I personally don't read it that way. I read just because of how the application is set out. So this is your S corporation and C corporation owner employees. Compensation goes up on one line, and then all group health and retirement go on separate lines. So just the mechanics of how the application is filled out, it does not tell you to reduce those lines for health insurance or retirement for your owner employees over $100,000. So absent that implicit instruction, I'm saying that you include them. So. And then probably just the other thing, will this extension to 24 months allow my self-employed or general partners, can we get to the 24, can we get to full forgiveness? And the answer is still no on that, because just unless they change the application, that mechanism of the lesser of, you will always get close, but you'll never get to 100% forgiveness as self-employed or general partners. So.
Okay.
Shall we start at the top of the questions and work our way down?
Sounds great.
So the first one, actually, there's quite a few with 2 votes. So the first one is I still have most of my team on part-time unemployment. The initial 8 weeks ended last Sunday. Expect to use the 24-week period. Any concern about the part-time employees, as I have used some of the PPP loan for the last 5 weeks? I guess maybe I don't fully understand the question. I wouldn't have a concern about the part-time employees because you would have 24 weeks or until 12/31 to restore your FTEs back to what it was before. So I don't know if there would be a concern there. Do either of you have thoughts on that?
I think just reiterate, yeah, because I think we have to get more information, but I mean, just in general for this person, if you still have most of your team in part-time unemployment and you're now going to go to this 24-week period, you now just need to understand that by December 31st, you need to get back to staff essentially what you had prior to COVID. Mm-hmm. So there's really, I don't know if I would get hung up so much on what you kind of have done in the past few weeks or maybe what will be in the next couple of weeks. It's really to apply for the loan forgiveness. You just get back to basics, what was your FTE count, go through those calculations. And then we've got to look at that 12/31 now count for the FTE. So I guess the concern would be is, are you going to get back to staff essentially by December 31st? Or maybe there's some issues in the business where you can look to one of those safe harbors and really not worry about it. So I guess that's my shot at interpretation of that question.
Any additional thoughts on that, Tony?
No, I think that's perfect. If you just kind of boil it down to simplicity, whatever your situation is, regardless of whether you're opening slower or you've had part-time, you look at the 8-week requirements and my 630 FTE measurement and the rates that I paid my employees, or you look at the rates you've paid your employees and that 12/31 FTE count as really your safe harbors. And those are your targets. Can I be fully staffed by either 630 or 12/31? And I think that's going to dictate, whether you choose the original 8 weeks or you go to the 24. So.
And on that thought, just kind of an open-ended thought I had, June 30 under the old rules versus December 30, especially in our world here, is far different for a lot of businesses. Seasonality issues.
Yeah.
What are our thoughts on that? In terms of, we got someone that maybe June 30 is like, yeah, we can actually look as if we have our FTE count up. I know there's rules back to there. I know there's seasonality rules, but maybe that's another risk of doing the 24-week application. You're now looking to that December date, and is that going to harm you more than the 630 date?
Yeah. Again, I think this Flexibility Act, really what it does is adds an additional complexity because now you've got an additional optimization to do, right? Yeah. Now I've got to do the calculations for the 8-week and I've got to do the calculations for the 24-week and see where I'm optimized. So.
I agree with that. I do think there is, if we're looking at maybe that seasonality or anything, potentially, depending on the period that they used as the look back, we may, if you're looking at pre-COVID numbers, and I know here with the season, we have a big summer season, a low winter season, sometimes depending on the type of industry. But it may be that the December FTE count's much closer to what that pre-COVID number was. So there may be something there as well that is a little
That's a good point.
Not as strict, or you don't have to try to match up summer hours with winter hours or anything. So it'll be interesting to see how that actually plays out for the seasonal people and how they actually allow us to test that information.
Great.
I think the next question is about cherry picking wages. They have one program considered non-essential with layoffs, and they applied for the PPP funds. And then we have essential services that grants specifically are able to pay the wages for. How would you do that? Either one of you two?
So really, they're almost separate mechanisms. So you've got, the bank and the SBA are going to need to evaluate costs that are allowable. So so I don't think you really have to cherry pick. You'll provide substantiation for costs that cover your loan. And then if you've got some other internal reporting mechanisms for specific grants, you're going to do that kind of a little bit separate from this.
Maybe I interpreted this question differently. I'm sensing that they're having an FTE issue. That's as if like maybe part of their business is gone from 5 FTEs to 0, and another one has gone from 10 to 10. And they're spending like daylights on the 10 to 10 and have no issues. Mm-hmm. So I'm wondering if they're thinking, can we cherry pick and look at that one division and say, hey, we're doing just fine here, but I think they're going to have an FTE issue. I think maybe that's what they're driven at. So this could be a safe harbor. That non-essential layoff, maybe if that's a COVID issue that you can't get back up and going, I wonder if they can look at those non-essential side that shut down as a safe harbor and say, you can omit you can omit those people from your FTE calculation. I think that's how I'm interpreting their question, but maybe I'm wrong. I don't know. So we answered a couple questions either way that could be applicable to other people.
Yeah, good point.
And I think that actually answers the next question about if revenue doesn't support all workers returning to work and we have to let people go. It sounded like that would qualify for that 24-week safe harbor if COVID caused their income to be significantly less.
Maybe. See, that's where we need more guidance, because is it because of COVID that I have a feeling it's not going to be because sales are down. I think it's going to be because of COVID. I couldn't return this employee because they had an issue, or I think I don't know.
I think what we're going to see is Montana, you're going to have a problem because Montana's going to be fully open, right? We're going to progress into phase 3 at some point in time, just based on the volume of cases, unless we have a blow up and the governor shuts things down again. So I think unless states have a stay in place order, I think that COVID reason is not going to be available to a lot of businesses. So I don't know that safe harbor is going to be available to many Montana businesses unless things change for us. That's my interpretation of it.
Yeah, it'd have to be an odd business doing food delivery to a retirement home or something, that just really, like, we shouldn't do that. We should not do that. So maybe you could look to that safe harbor that way. Good point, Tony.
Yeah.
Is the FTE during covered period expanded to average of 24 weeks or still just 8 weeks from funding date? Is our next question. You want to tackle that one, Tony?
Sure, I believe it. So you're looking at the average over your covered period. So if you're going 24, so you're going to have to calculate your average FTEs over your 24-week period and the 12/31 safe harbor date. So,
yep.
Yeah.
I would agree. Can a business refinance a building under the EIDL? Tony, you kind of hit that slide of what you cannot use funds for. Was that on there, or can you expand on that question?
Yeah, it was. So refinancing of debt is a no-go.
Yeah. That's my interpretation as well.
And so, also, if you've got any other federal program debt, that's also a no-go, principal and interest. So even your regular payments on other SBA loans, or any other federal program loan in your business, that's a no-go for principal and interest, and then you can't refinance any other debt.
And the next question, I think, is applicable to almost every business here, really. So if as an owner you have taken more than the percentage allowed via payroll, can you ask that it is not forgiven and apply other payroll costs to the forgiveness, thus not reducing full forgiveness? So, I mean, yes, you don't really ask for it. It's just, and hopefully you have all these other payroll costs that help get you far up and over the amount required. So unless I'm misinterpreting that question, I think it's kind of just as simple as, yeah, they're not going to look at, because chances are there's going to be a lot of businesses that pay more than that $100,000 equivalent. It's just that you're limited up to those certain amounts. And so same for you as the owner, you're going to probably potentially could pay yourself more than the allowable forgiveness amount. You're going to look for other allowable wages to get that forgiveness. So it should be just fine. Okay, one just jumped up into the front spot. So are we saying it must be either 8 weeks or 24 weeks? You cannot choose a 10-week if you have spent the money and are ready to submit after 10 weeks. No, it's 8 or 24. It's 8 or 24. I think everyone is going to, what it should have been, if hindsight's 2020, it should have been a 12-week deal, because it just seems like everyone needed just one more month here in Montana. But the answer is it's either 8 or 24. And so what's going to happen is that people are going to finally get to that point at week 10, week 12, week 14 and say, gosh, let's get this over with. But as we've discussed today, we should just kind of analyze whether you can get everything done in 8 weeks. And if you can't, you're going to probably want to do the 24-week method. And then let's just wait for a little bit more rules and guidance to come out to hopefully streamline that process and make it seamless for us all.
Yeah, we may be pleasantly surprised when the guidance comes out and they allow some flexibility and maybe use the language of up to 24. You've still got that 12/31 measurement date out there. So if you're having to rely on a safe harbor, you're going to have to wait till then anyways. But hopefully we're pleasantly surprised. But I haven't read a single shred of interpretation that allows for a 10-12 flexible period. So it's 8 or 24, I agree.
I'm going to quickly read the next one so I don't have to answer it. And it is, do either excise taxes to another state or our 1% our contractors credit qualify for loan forgiveness? So, go ahead, Tony.
It doesn't fit into the definition of what they're asking for in the application. So if you go back to the CARES Act, it says a tax, state or local taxes assessed on wages, on compensation. So if it fits that definition, you might be able to put it into the loan application. But really, if you kind of follow through the mechanics of what they're asking for on every specific line, there's really nowhere to put something like that. So.
Yeah. I would agree. These are taxes tied to more like your revenues, which I don't think. Yeah. Since the update to the law, if we have spent the loan by 10 weeks, so we've answered that one. I think a lot of people are kind of wondering, is there a tweener? There's not. Do we have flexibility to pick and choose? We answered that one. Thank you, Aaron. Thank you, Aaron.
Hey, that wasn't me. That was Tony.
Oh, okay, Tony. All right. We are getting reminder if you see a question, it will get right to the top if you voted up. So do that. And where are we at here? We are spilled over our 10 o'clock per usual. So a lot of people are still sticking with us. So we thank you. We'll take another probably, what do you think, guys? Another 5 to 10 minutes of answering questions. We have about 40 left to answer.
I think some of these are going to be
duplicates,
very similar. So I think we can get through a good chunk of them.
Great. So and they're now in order of kind of when people submitted them. So we're trying to get to these as fast as we can. Does that mean that payroll costs till 12/31/2020 will be included, yet rent and utilities for the 8 weeks? So this is our big our big unknown, I think, that we need some clarification on. So I think the question is, are we still limited to that old 8-week calculation on payroll, or 8 weeks of rent? So now that we're getting through, we have a 24-week period. Can I do rent for that 24 weeks? I think that would be our interpretation in terms of those non-payroll costs. I think they're real, and especially that aligns with the change from 75-25 to 60-40. They're kind of saying, okay, if you're struggling to spend that much on payroll, and you're sitting there with an empty building, let's let you take a little bit more rent, which would align with the fact that they're trying to let you use more, go that 24 weeks. The big question that I think is still out there, Aaron talked about it, Tony talked about it, it applies to that question, is can those limitations on payroll expenses go beyond that 8-week calculation, or is that opened up to a 24-week calculation? That's to be determined. That's going to be a huge change if they decide on that.
I believe that we see that difference because in the application and all of the guidance, it's always, for the compensation, it's always said 8 of 52, like 8 weeks of 52 weeks with the cap of 100,000. It's always used the number 8. Now with the other expenses, it's always mentioned other covered costs, or the covered period. So if they had said the covered period divided by 52 weeks, or using that, then we could see them extending the cash compensation up to the 24 weeks of annualized compensation of the 100,000. But I think that verbiage is what's making some confusion out there, is that they used eight weeks of compensation and then used for the other expenses, it was during the covered period, which was 8 weeks originally, but now can be 24. So there's a little, just a like text difference there.
It's a great point, Aaron. Tony, can you remind us about the EIDL, the reporting requirements as to how the funds are spent? Are there reporting requirements? Maybe quickly break that question down.
So there are not reporting requirements. You're talking about basically an assertion. So you're making assertions when you sign those loan documents that you're going to spend them on allowable items. There's no subsequent reporting though. So.
Okay.
And then there's also a EIDL grant taxable question down a few. I'll just tackle that. So again, the EIDL grant is forgiven. So you got tax exempt income. So the expenses associated with that are not deductible. So if you can use the EIDL grant on principal loan payments, which are not a deductible item anyways, now you've made that EIDL grant not taxable. But if they're used for any supply costs or payroll costs or mortgage interest, which are deductions on your tax return, those deductions would be disallowed and that EIDL grant would be essentially taxable. So
the next question that's come to the top, I think I just kind of talked about it, and I think it's one of those ones that I think we just need a little bit more expansion on. The way that they wrote this question is a fantastic way to put it. Is so being open doesn't mean that revenue will return to pre-COVID levels. Thus, they don't anticipate it will over the next few months. So would the safe harbor apply? So I'm assuming we're talking about the FTE safe harbor. And yeah, I mean, I haven't quite thought it through just yet. I was just waiting for more guidance. But yes, I mean, I'm thinking maybe there's a COVID issue with the employee, but if you have a staff of 15 and you just don't need that staff because of COVID driving sales way down, there's no one coming through your doors, you're open, but there's just not you don't need that much staff. Does that reduction then qualify you for that safe harbor provision? That would make a lot of sense. You maybe necessarily shouldn't be harmed by the fact that COVID's driven down business, which drives down the need for employees. Maybe that's what the true, we don't, I mean, they left that one open-ended for now. We'll get more guidance soon and share that, because I think that's probably the intent. We just need to confirm that.
Yeah, I think that would be our hopes. I don't believe that the mechanics will work that way. That's my personal opinion, because that substantiation is very difficult then for the SBA to evaluate. So,
right. If a business decides to apply for forgiveness in the 8-week time frame, do they still fall under the new safe harbors for the PPP Flexibility Act? Seems like there's kind of two different set of rules, but I would say, I'm shooting from the hip. I'm going to say no, because you are under the 8-week period. You're going to have to go off of your June 30 FTE calc, and that's contrary to a safe harbor that's telling you, hey, you can use a 24-week period, and now you have a December 31 deadline. So I think we're looking at two different methods: an 8-week method, a 24-week method, and you can't cross pollinate there.
Yeah, and I think potentially maybe they're asking about that. I can't open fully safe harbor, but I don't believe that's. And again, you're asking to do it under the original 8-week guidance or the new 24-week guidance. So I don't believe that additional safe harbor would be available.
One more reason to wait to file for forgiveness. Wait for more guidance.
During the 8-week program, we only spent, the 8-week period, we only spent 80% of the loan, the PPP loan. Are you now saying during the 24-week program, we can now spend 100% of the loan? Yes. Yep. That's the beauty of this extension, is that everyone could have used maybe a little bit more time. And in your case, as long as you're open and have qualified expenses, you're going to probably reach that, that 100% forgiveness amount. And then their follow-up question is, can we apply in 10 weeks? And the answer is no, it's a 24-week program.
Aaron,
go ahead, Tony.
Aaron, do you want to take that? I think it's that next question is 75% question. I believe they're maybe mixing up the wage reduction versus the FTE reduction. Great.
I was reading it. I'm like, I'm not sure what this is talking about. So you do have a limitation or a reduction in forgiveness if you've dropped someone's wage rate below 75% of what their wage rate was before, like from Q1. In this case, for your hourly employees, if you dropped their wages, their hourly rate more than 75%, then you would still have that reduction. Salary is a little different unless they made over 100,000, in which case you could do a reduction of wages for them without having basically any penalty on that. Was that answered? You made the question go away too fast, and now I don't remember what it said.
So I think the point there is that the 75% applies to the wage rate, not the FTEs.
Yes.
So if FTEs decrease 10%, you've got a reduction. So that 75% threshold doesn't apply to FTEs. It applies to the wage rates, I think was where I was pushing you.
Yes.
I'm going to skip down to one question, I think, because we're holding participants strong. And this one, I think, is a good one to know. They're wanting us to explain more about the deferral of the employer portion of Social Security. So again, that is now available to those who have PPP loans. You can defer the time you have to pay the employer portion of the Social Security. I believe if it falls under the rules of the original intent of deferral, you could essentially push it out for 2 years. Half would be due by 12/31/2021, and the other half would be due by 12/31/2022. Interest-free, I mean, pretty significant, right? Just don't forget to pay them. That'd be my only concern. Aaron, any insight on how that looks on the 941? Just the mechanics of it?
Yeah, there are the draft 941 and perhaps the finalized one has been issued. There are specific lines for the deferral of the tax, the employer portion of Social Security. There's also lines for the refundable employer retention tax credit. So it's much expanded. It's about 4 pages long with a couple worksheets as well, so it's even longer. But there are specific lines. I think the biggest thing to remember with the deferral of the Social Security employer Social Security is that it is just a deferral. You will have to pay it at some point in the future. So think about how you're going to track that if you are going to take advantage of it, how you're going to track it, and how you're going to remember to pay the amount. Because I mean, that's the first 50% due 12/31/2021. That's a year and a half away. So just make sure that you're tracking that. If you're taking advantage of it, you have reminders built up that's going to help you keep that as something that you need to do.
Excellent.
So the second question there, the one that just dropped down, I'll kind of just answer that. It's basically asking about an employee who worked part-time in 1 week in the covered period for various circumstances. So for that 1 week, if you're using the simplified method of a 0.5 or a 1.0, yes, for that 1 week, that employee would be a 0.5 FTE. And then all the other weeks that he worked 40 hours, he would be a 1.0.
So I read this differently. Don't make it go away yet. I read it differently in that the employee, if they're paid for 40 hours but only worked 16, there's still a 1.0 FTE.
I'd agree, Aaron. So
Okay.
if they got paid for 40 hours, then that's a 1.0.
Yeah.
So a little
So
bit
on that 1 week, he only worked for 16 but was paid for 40, then he would still be a 1.0 and he would not be a 0.5. And technically, he wouldn't really be available for that. He wouldn't be eligible for the extra $600 for federal employment.
Okay.
I scrolled down and found a question that's a great plug here. And they were asking, most of these financial details are over my head. Is there a list of Montana accountants or bookkeepers that have received training or updates on PPP forgiveness who can be recommended to assist someone like me in completing the PPP forgiveness application?
Well, I can tell you that JCCS has we have a full COVID-19 response team with multiple representatives in every single one of our branches that are fully trained on the aspects of PPP. And we've developed our own internal tools for calculating forgiveness and modeling. So you can certainly reach out to your local JCCS office or any one of us and we can direct you. So yeah, absolutely here to help. But other than JCCS, I'm not aware of a listing of service providers. So
I'm experiencing a lot of my clients as bookkeepers reaching out to us. It's just, and we are, a lot of one-off questions. I know this panel has been just, I've seen Tony's emails, he is going to town. So we're happy to assist, especially on those one-offs. As we start getting more in depth, we're really excited to help folks do that whole calculation from start to finish.
Yep.
So, what do we think, guys? There's still several outstanding questions. Our slides in this webinar are going to be available online. Our emails are on there. So if you have maybe some specific questions we didn't answer, send to us directly. We're happy to answer those. Did you guys see any other questions that kind of you wanted to hit before we call it a day? We're still holding at about 100 people, so we appreciate everyone listening to us again.
I'm going to take one on I got EIDL on my mind here. So the one about, can I take out an EIDL? If I did not take out an EIDL, can I take one after getting the PPP forgiveness without tax consequences? So if you apply for forgiveness and receive forgiveness and then still fit within the timeline of when the EIDL is available, hypothetically, yes. But remember, if you ask for an advance on the EIDL and your your forgiveness has not been completed, that EIDL advance is backdated to February and will reduce your PPP forgiveness. So the sequence is important, and the availability dates are also important on that.
I think how we should finish today is, I think a lot of people if today's not the day, I remember this, to me, it's like this mid-June number. I think a lot of people are almost right on there at the end of their 8-week period. Mm-hmm. And so if I'm a business owner and I'm, this is very overwhelming stuff and I've got help, I'm looking for help. The bankers are saying, ask your accountant, we're waiting on more guidance, yada, yada. And so there's kind of this, maybe I think, a little concern of what do I need to do today, tomorrow, next week? So what is our message for those, just an understanding of what the next step is? In general, we've got this 24-week extension. So obviously, don't just stop thinking about it for the next 23 weeks, or, however many weeks it is until that date arrives. But what's both of yours overall message of just what's a good next step to take? Go ahead, Erin.
I would tell.
She had no idea I was going to ask this question. Sorry, Erin.
I would say next step is take a deep breath. For me, I think we need to wait a little longer. We have time. Yes, you could go out and get forgiveness, but or start applying. I don't necessarily think the financial institutions are ready. In my opinion, the next step should be just breathe a little bit. Breathe and then see what more guidance comes in. As we get past the 631 for those 8-week, those people that choose 8 weeks, hopefully we'll get a little bit more clarity. But that would be my next step.
Yeah, I don't know that I have any different message there. Again, we're going to be there for you. If there's significant changes, significant things are going to impact you as a JCCS client, we're going to let you know. So yeah, absolutely. A little bit of patience, just breathe. We'll get through it together. Yeah.
And on those notes, if we are liking that 8-week period, so we are trying to use the original method, that deadline for that loan forgiveness application is October 31st. Mm-hmm. So even if you are wanting to kind of get ahead of the game and use those original, those forms, we have until that time, in which, that's a lifetime in terms of how many different guidance releases they have been giving us. And so, we could see countless more between now and then. So, yeah, great advice, guys. Thank you.
Yeah, great question, Jake. Well, with that, I think we are going to call it a day on Q&A. So again, if you had a question that you didn't hear answered or still have some follow-up questions, please feel free to reach out to one of the panelists or your local JCCS representative, and we'll get that question answered for you if you've got some very specifics. So again, have a great weekend, and thank you all for joining us today.
Thanks, everyone.
Thanks, everyone.
Thanks for joining us.